Hello everyone and welcome to this ESG Clarity Roundtable this morning, which we've titled Why Social Factors Matter in Emerging Markets. I'm Adam Lewis, Content Editor at Bonhill, and in today's roundtable we're going to be talking to John Citron, Portfolio Manager at J.P.Morgan, to find out why companies who get it wrong on social issues in emerging markets are more likely to pay a higher price than their developed market counterparts. Of course, ESG investing has seen a huge rise in popularity in recent years. But today, John is going to talk about how the S in ESG has been a driver of company performance in the emerging market region since before sustainability became a mainstream consideration for investors. To help in the discussion, I'm also delighted that we've been joined by Ryan Hughes, Head of Investment Research at AJ Bell Investments. So, John, to kick things off, lots of emphasis is always placed on governance and environmental issues when investors look at emerging markets. But just how important is the social element?
Yeah, the social element, of course, is very important, and I think especially so in emerging markets. But I think what we certainly feel at JPM Asset Management is that the three parts of ESG, the E, the S, and the G, really fit together in a whole concept. And so to that extent, I think you can say each part has its role to play. And I think it's always worth in these discussions kind of addressing that question up front. Why do we talk about environmental, social, and governance together? And I think that kind of really sets a backdrop for any conversation on social. And the way I think about it, and I certainly think we think about it here, is that they make sense when you think about kind of what companies do and what we're doing as investors. So as investors, we're investing in companies, and what those companies are doing is taking economic input, turning it into economic output. And basically, there's only really three types of economic input. There's input from the natural world, which basically is covered by environmental. There's input from the human world, covered by social, and then there's input from the financial world, covered by governance. And that's really kind of where the base of this E, S, and G comes from. So if you were to think of a software company, say it needs natural resources like silicon transformed into computers. It needs developers, people to write the code, and it needs money, capital to pay the developers and buy the computers. And so you've got the natural world, the human world, and the financial world, and that's really the inputs to a company. And also, as a company operates, it then has an impact on the world around it. And again, that impact is really only in three areas: on the natural world, the human world, and the financial world. And so, I suppose if the question is where does social sit, it sits in this holistic sense of what does a company need and what are the impacts a company has on the world. And really, what we're looking to do when we think about ESG is trying to understand what is sustainable for a company, both in terms of the resources it needs to operate and the impacts it has on the world. And social is clearly a part of that, because it takes all the human inputs and the human impacts of a business and puts them alongside the other two types of inputs that a business can have. And so that's really where social sits. And I think that particular part of the discussion is kind of a bit less emerging market specific. That's just true kind of in principle and in all places. But obviously emerging markets has its own considerations, which we can get into later.
Ryan, is it, is obviously ESG and sort of emerging markets are something that, more and more sort of fund selectors are sort of looking at. So how much attention do you pay to the social element when it comes to your, I suppose in today's discussion, emerging market investments, but holistically, as sort of John's talked about as well?
I think it's really encouraging that actually the S has always struck me as kind of the forgotten letter of the trio within ESG. And if you think about emerging markets, and I've been doing this for a very long time, and for years and years, governance was the only issue that people worried about in emerging markets. It's actually quite encouraging, I think, that I can go to an emerging markets meeting with lots of other fund selectors, and people don't raise the governance question anymore. I think it's actually really good now that we can start talking about the social side of things, because at the end of the day, it's the people element that drives a company. No company can exist without their people, without a happy team and happy staff. And I guess we've seen lots of that through COVID, which we might come on and talk about, how businesses treated their staff through COVID, which has been a real eye-opener, I think, for lots and lots of companies. And you've kind of worked out whether you work for a good employer or a bad one in some respects through that, particularly in some of the more challenging economies. So yeah, we do think about all elements of ESG, but yeah, social is that little one that's perhaps proved to be a little bit harder. It's in my side, it's perhaps a little bit harder to measure in terms of how a company is delivering on that. And so it'd be great to talk through some elements of that as well, John, and see how you go about that, and see how we can kind of factor that into our thinking from a fund research side, assessing a fund like yourself.
Excellent. So maybe, I mean, we'll hope these are all good points that we're sort of going to get onto in sort of some way. So John, you know, do social issues matter more in emerging markets than they do in developed markets? Would you prophesize?
The way I would put it is that I think, you know, they don't matter more. You know, this is about treating people well, and that's something that everyone should be doing. And so, in a sense, I don't think you can say it's more important to treat people well. I mean, it's just something, you know, it's just a good thing for businesses to do. I do think that the costs and opportunities in emerging markets to getting these things right and wrong are bigger, and that's really a lot to do with two sides of the coin. One is the kind of parts of emerging markets where you have an excess of state and government intervention, and the other is where you have an absence of government, really. So I guess to maybe give you some examples to illustrate that, you know, the real kind of big case study of the last few years in terms of getting social wrong having a cost in emerging markets, at least, has been the Chinese after-school tutoring market. This was a huge industry. You had companies with combined market capitalization over $100 billion. And the Chinese government came out overnight one day and effectively outlawed the entire industry. Stock prices fell 95% and $100 billion of shareholder value was wiped out. Why did they do that? Because they felt that these companies were having a negative effect on society. They felt that it was causing students a lot of stress because they were basically going to school, then spending all evening and all weekend in these intensive tutoring classes. They felt it was creating issues for the demographics of the country. You know, people think of the one-child policy in China, but they've moved far beyond that now. And if anything, and I think there's a 3-child policy. They're trying to encourage people to have more children overall. But they felt that the costs of tutoring were preventing families from having more children, and therefore the aging society problem was getting worse. So for all these reasons, they just shut down the industry. And you know, I think when we look at the industry, you could also see that there were ways in which the companies within that could have managed themselves better and maybe avoided some of these problems. You know, there was a lot of very aggressive marketing campaigns, you know, talking about how parents would really be letting down their children and ruining their life chances if they weren't involved in this industry, and so on. So there's an example where you have a kind of very strong interventionist government and regulator, and if you get on the wrong side of social issues, you can just see your company you know, taken away in effect. So that's a downside. Where there's opportunities are kind of where there's an absence of the state, and then the private sector can step in and provide some social infrastructure and social good in the way that's needed. So a great example here, I think, is the digital payment space, and you see kind of different approaches in different markets and emerging markets. So some bigger countries like India with UPI, Brazil with Pix, in those countries the government has kind of built the basic rails on which digital payments will operate. In other countries, governments haven't done that and the private sector's come in. So if you look at Kenya, you have the local telecom company Safaricom. They essentially built the digital financial system in the country with something called M-Pesa, which is a mobile money app. And it's kind of a very amazing statistic, but now 50% of Kenyan GDP flows through M-Pesa, which is this, you know, app owned by a private sector company. And that really is a social good because, you know, particularly in emerging markets, cash has long been associated with a host of problems, notably violence in cash transport, but obviously during COVID as well, there was then health problems associated with it as well. So this was a social problem being fixed by a private sector company because the government wasn't there providing an alternative option. I think, you know, the interesting thing you see in cases like that is that obviously when you're providing a kind of quasi-public good, you need to be quite responsible about how you're managing that. And, you know, Safaricom again is a great example of a business that does make good profits, but also has a very large program in terms of doing good in local society, around education, around health, and so on and so forth. So I think yeah, two examples. One business has been a fantastic investment. Obviously, after-school tutoring in China turned out to be a disastrous investment, and it was both social issues and opportunities. And it's I guess it illustrates how you can get these pretty big outcomes on both sides in emerging markets.
What's the sort of just before bringing Ryan in, because it's sort of paid to what he's thinking, but what's the gap between the sort of the best and the worst performers? Is it quite large, and does that mean the opportunities available to those who can address it? That there are a number of opportunities.
Yeah, I think within any industry you tend to see a wide range of performance, and that can drive divergent outcomes. So to take one example, and it touches on a point Ryan was making earlier about the way workforces were treated during COVID, although it's part of the answer. Within emerging markets, we have a lot of textile companies. So these are companies manufacturing footwear and clothing for companies like Nike and Adidas in places like Vietnam, China, so on. And we have long taken a view that the companies in those supply chains with the highest standards with regards to how they treat their labor, i.e., on these social issues, will do better over time, even if it implies higher costs within their business. But because these multinationals like Nike and Adidas are very wary of having supply chain problems, scandals, and mistreatment of workers. And we have analysed these companies in great detail. We've looked at issues like what kind of dormitory provision there is for workers, what kind of water is available on the line, if they're pregnant workers, are they kept away from toxic chemicals, all sorts of different issues we've looked at. We've scored 8 companies, this was going back 4 or 5 years, on these different issues. And what you've seen over that time is that the company with the highest standards has materially outperformed the ones with the lowest standards, and essentially those with low standards have lost out contracts as people have tried to audit their supply chains and do better. And the reason it ties into COVID is that when the pandemic broke out, you basically found companies with low standards in these chains had to keep their factories shut for a lot longer, because suddenly the governments were coming in and demanding certain hygiene conditions in factories, and in some factories they just hadn't existed before. Whereas for the best performers, and in particular I've got in mind a company, Shenzhou International, which we've been long shareholders of. They were basically able to keep their factories open, and by keeping their factories open, they then won more contracts, more business, and it accelerated the market share gain that was happening anyway. So that's just one example, but I do think you do see a difference in performance, and that can be social treatment can be a big driver of that.
So Ryan, do you think this is something you're going to, is it something is something you sort of agreeing with, and is it something that you think you're going to have to sort of factor into your sort of EM fund selection sort of going forward, and ranking the importance of this sort of the social versus the E and G factors, which you sort of mentioned before hadn't really been discussed?
I think there's a lot of issues. I was scribbling notes there as John was talking. There's so many issues I think that come out of the answer that John's given. I mean, certainly from our side, we absolutely, I think you've got to think about the impact that companies have on the environment, on their staff, and every aspect. So the E, the S, and the G, I think they are all very important. And certainly, we see over time that companies that treat their workforce better are likely to have things like better. This is something that's true across the world, not in EM. They like to have better staff retention. That should lead to hopefully better output. That hopefully in turn leads to better profitability. That might lead to faster dividend growth. So all of these things are true whether you're looking at a UK market, a US market, or an EM market. And certainly I'm always acutely aware that we often I think we sit here in a nice developed Western market talking about how great we are, and we forget that things like Boohoo happened on our watch in the UK, or P&O has happened right now, firing 800 staff and bringing in effectively slave labor. So I think we're in no position to kind of lecture other parts of the world that they need to do things differently, and in some respects they're actually leading the way. But that's kind of by the by. One thing I was interested in just exploring, John, was just around obviously emerging markets covers a very wide range of different economies and spans the globe. Are you seeing quite a lot of regional or country differences in the way that governments are approaching the social side of things and how they're engaging with companies? Obviously, we hear lots about China, and we've seen the China education story that you've talked about. But what about other areas? What about maybe South America, emerging Europe, and those types of areas? Is there a very different approach that you see when you're looking at companies?
Yeah, it's a great question, and you're right that there are emerging markets is made up of such different countries, and so if you take Saudi Arabia, Mexico, and China, there's just so many different things going on in those political systems, societies, and the issues are different. In the Middle East, it might be more about slowly improving female participation in the workforce. In China, it might be more around kind of issues around worker rights and labour safety, and in other markets there might be other considerations. So yeah, you're right. The issues tend to vary, and I think they vary in a few aspects. One, they vary depending on the type of industry that's predominant within the country. So we still have some smaller emerging market countries where, for example, primary commodities are a much bigger part of the makeup of the economy, and so then there tends to be a lot more about health and safety and kind of minimum provision standards with regards to worker protection, working in mines and energy fields and so on. You have other countries where income levels are higher, and therefore the social issues tend to be more around what the minimum provision of the state is from the tax base that they're taking, and so on. And so as I say, so in some societies we look at, you see quite a lot of progressive work has been done on areas like gender participation in the workforce, and others there's obviously a lot further to go. So yeah, it is very different in different markets. That said, there are some kind of similar themes that you see. So for example, regulation of the platform economy in the internet space, although I guess you've seen more headlines in a place like China where there's been a lot of regulation of some of that stuff. At least part of that regulatory work around the rights of delivery drivers and so on reflects developed markets, and it also is reflected in other emerging markets. So the Indian government's worried about how delivery drivers for their leading restaurant delivery app, in that case called Zomato, are treated. And again, in Brazil, you have a local champion, and the Brazilian government's worried about that issue as well. So yeah, you're definitely right that it's very country specific, and within countries it tends to depend on kind of demography and economics, but there are kind of also cross currents that you see across markets as well.
Excellent. I don't know if you've got any more questions on Ryan, or any sort of follow-ups on that.
Yeah, I've got lots, to be honest. I could carry on. I'll just follow up with another one, just kind of continuing with the China education theme, which is as someone that looks at asset allocation, thinks about emerging markets. I think one thing that we need to think about when we're looking across the world now is with the Chinese government intervention. That's clearly spooked a lot of people. How do you think we should think about repricing the risk premium when looking at emerging markets? We've got enhanced, potentially increased government intervention. We've got social issues that are obviously really high up the agenda, and standards are improving, which is great to see, but further to go, just like everywhere. Should we be thinking about the risk premium in emerging markets a little bit different now, given what we know compared to maybe what we knew 18 months ago?
I'd answer it in a few ways. I mean, I think there's a general comments, and there's probably China-specific comments. Look, I think emerging markets are always an asset class which should command a higher risk premium for all sorts of reasons. One of them is political intervention, but there are other ones as well, related to foreign exchange risks and other types of issues that can exist. And I don't think that's necessarily changed. I think sometimes you're served a reminder of what those risks are, but those risks always exist, even if they're not necessarily playing out day to day. And the offset, hopefully, in emerging markets is that it's a higher risk, higher reward asset class, and the higher reward should hopefully come from higher growth. We still have a lot of countries in emerging markets with pretty high domestic growth rates within the economy. China's still hoping to hit 5.5 this year. You have India, which structurally has been a high growth rate country. You've got places like Vietnam growing very fast. So I mean, I think that's what you look at in emerging markets. I'm not really sure that paradigm has really changed. Yeah, it's certainly true that in the last 12 to 18 months, a lot of the kinds of risks you would worry about have happened. But in a sense, when you think about risk pricing, you're worried about the risks that exist regardless of whether they've happened or not, and the fact they've happened, I'm not sure changes the assessment of where the risk price should be. I think, China specifically, clearly things have been, it appears that the political economy has shifted towards a somewhat more regulatory and interventionist phase, which is clearly not helpful from an investment perspective. I would, I guess we would split to some extent between different industries within the economy. Clearly, the tech sector was and to an extent the education sector. These are kind of big employers within the economy. They have a big impact on children as well as adults. Education clearly, but even within the tech sector, on issues like mobile gaming, there's been a lot of the regulation that's gone in there has been about protecting children, so that you're now unable as a minor in China to play mobile games, during school time in the evenings, and other restrictions have been put in place by the government. So I think we would kind of look and see some risk in those industries, and certainly the risks there have probably gone up. On the other hand, you have a lot of very normal businesses in China where I'm not sure the risks have changed that much. So, for example, we have a long-standing investment in a number of food producers in China, like the largest domestic soy sauce manufacturer. I mean, it's hard to think of a scenario in which the government cares too much about, the price of soy sauce or, the impact that has on society, because there isn't really an impact. So I think, in a way, those are more micro level discussions. And I think, yes, the risks are higher in emerging markets, but equally some of those do reflect concerns you see in Western markets as well. So, if you're thinking of investing in Facebook, one question you'll be thinking about is the regulatory risks that exist there and whether you're happy taking that. And clearly the regulatory risk is somewhat more asymmetric and can be somewhat more volatile in emerging markets. But I don't think, as I say, I think you can get some comfort by thinking on industry level. And in China as well, I think we do have the feeling, and this is certainly a view shared by our colleagues who run our China funds, that ultimately the bottom line for the government in terms of the social compact they have in that country is growth. And the regulatory interventions came in a kind of growth period of higher growth tailwinds when there was a recovery, although it turned out to be an abortive recovery from the COVID wave. And again, now this year you've seen growth struggle a bit more, and in response to that, you've seen the government clearly step back from the regulatory agenda as they try and defend their 5.5% growth target for the year. So I think there is a bit of a trade-off as well in China where things are better in the economy, you'll see more regulation, and when things are weaker in the economy, you see less regulation, and in a sense that can be something of a self-corrective mechanism.
If I can bring it into process a little bit then, because it's something sort of, Ryan, that you mentioned at the start, just in terms of measuring this. Can I just go into a little bit about how your team go about measuring social factors when it comes to selecting companies for the fund, and then maybe we can go into some more case studies.
Yeah, definitely. So look, social is harder to measure than environmental and governance, and it's also harder in all three factors are probably harder to measure in emerging markets. And the reason social is the hardest of ES and G is that there's just less quantitative data out there. If you're talking environmental, you can look up the carbon emissions of the company in tons. If you're thinking about governance issues, you can look at the percentage of independent directors on the board. You can look at dividend payout ratios. There's kind of hard numbers you can anchor to, and that's a lot harder in the social sense. There is some of that data in developed markets. So, people tend to look at things like Glassdoor surveys of employee satisfaction and this kind of stuff, but those sorts of data sets don't exist to the same extent in emerging markets. What do we do? Well, the research approach, as with everything we do here at JPM Asset Management, is very much set at the global level. So we have a kind of global framework that emerging markets help lead on, but ties into. And there's two parts to it. So firstly, we have this 40-question ESG scorecard that we score every company that we cover in the world on. So that's, we're asking the same questions of Apple, Nestle, but also companies in emerging markets. And that's really all about highlighting risk factors that could exist within the company. So this is a yes/no checklist applied to all companies, regardless of geography or industry. So the social questions there include, I'll read them to make sure I get them right. It includes things like, does the company have issues with labor relations or retention? Are mental health concerns raised by the company's product or its working practices? Does the industry have a special political sensitivity or importance? So we're flagging those as yes or no, and if the answer is yes, and obviously we're kind of A, aware of those risks, and B, we then score that red flag 1, 2, or 3, depending on how serious we is. The analyst will write some comments. So that's kind of at a very generic level. And then within every industry, we have what we call a global ESG materiality framework, which is looking at what are the real issues that matter within this industry. And typically for most industries, there are some social issues. So again, to give an example, if you look at the pharmaceutical industry, what are the kind of questions we're asking there? Well, here we have questions like, how compliant has the company been with the quality standards set by regulators? How responsible has the company been in marketing its products ethically? How proactive has the company been in improving access and affordability of drugs? So these are kind of social issues, but very much at an industry level. We have 5 of these materiality questions for 50 plus separate sub-industries. We score them 1 to 5. And again, that enables us to see which companies are leading, which companies are laggards. So it's a slightly more qualitative, judgmental-based approach across the whole thing for ES and G within these 2 frameworks. Obviously, we supplement that with data and various, both internal and external data sets where we have them. But within social, within emerging markets, we are kind of more relying on our analyst view. But we're in the fortunate position here of having a big analyst team, based locally on the ground who have pretty good insights into what companies are doing.
Ryan, any sort of questions on in terms of that process, or just how you might sort of go about, you obviously sort of see different ways groups go about measuring sort of different impacts, any sort of comebacks on that?
Yeah, I mean, I guess from a process perspective, we know the J.P.Morgan team well, and what we like is a consistent framework. And a consistent framework's got depth, and that's really, really important for driving consistent outcomes. So that certainly ticks a box from our side when we're researching funds. One question I had for John, which I'd be interested to get a perspective on, is just how you're seeing the level of engagement from management in terms of listening to you asking these questions and the quality of answers that you're getting, and are you getting that real sense that they are genuinely taking these points and the feedback that you give them on board, and are you seeing real change in the companies because you're having that level of engagement?
Yeah, definitely is the answer, and I think it reflects industry trends. And I think I would certainly say we are a big shareholder in a lot of companies and an important voice in the debate. But obviously, it would be it would be obviously untrue if I had to claim that we were the only voice in the debate. And the fact is that companies hear all their investors, as well as their regulators, as well as their employees, talking more about ESG type issues, and you're seeing a corporate response to that. I think the way we tend to engage with management is very much within the frameworks I just talked about. So what we think is important is really what we think is material within our materiality work, which I just mentioned. So we'll tend to look at which companies are scoring less well and really engage with those managements on the areas where we think that they're shortcomings. And I think management are very open to those conversations. And particularly, I think we see more. It's very much a 2-sided conversation, not a one-way conversation. So sometimes companies will come to us and say, we're thinking of putting in ESG KPIs for our senior management team. As shareholders, do you have any views on which ones these should be? But equally, sometimes we're going to companies. I'm trying to think of a social example. I guess one that came up recently, we had an e-commerce platform within emerging markets. There had been some reporting in the media and also with some trade regulatory bodies suggesting they were selling counterfeit products on their marketplace that were infringing patents. And so we called them up, we arranged a meeting with them, we asked them what they're doing about it. And they had some good answers, some less good answers. And we're also able to then point to companies which we think have better practice on it and kind of say to them, look, this is what best practice looks like, and we'd expect you to get there over time. So I think, it is a area where you're seeing a lot of progress. And as I say, I think that, being a voice in that debate is very important. But obviously, if a company changes what it's doing, we have to be realistic. Partly it's because we've been a voice in the debate, partly it's because there are other voices in the debate pushing them in the same direction. So I think it's very rare you meet corporates now who aren't thinking quite hard about all of these issues. I think that obviously the challenge as investors is recognizing who has really committed to this and means what they're doing versus those who are kind of entering a kind of PR type exercise. saying what they want people to hear. They haven't thought about it so much from the first principles perspective.
Just kind of extending that one step further, right back at the start, you mentioned about supply chains, and I know, again, I'm curious as to, so we've got management now really trying to understand their business from an ESG perspective, really thinking about social, but is that now extending out more to looking down their supply chain to try and drive up the standard from a kind of end-to-end perspective, or are they still quite focused on their own business?
Yeah, again, I'd say it's an area where the direction of travel is clear, and as you say, it's towards supply chains, and in a way that's come from the environmental side, where people started talking about scope 1 emissions and then scope 2 and scope 3, which obviously gets you further into the supply chain. But I think you see that on social side as well. I guess where, in terms of kind of where different industries are with respect to that, I would say places where you're more directly facing the consumer, probably there's more pressure from the people paying your bills, the consumers buying your products, on some of these issues. So if you look at food retailers, we've seen food retailers across emerging markets come out with more commitments in terms of where their products are coming from and who's behind the rights of the workers making those products and so on and so forth. Where big parts of emerging markets are the supply chain. So we have companies who are obviously making stuff within the Apple supply chain, making stuff within the Nike and Adidas supply chain, and then obviously you're seeing standards rise. One of the reasons you're seeing standards rise is that their ultimate customers are worried about their supply chains, and then that kind of feeds down to the level at which we invest in emerging markets. In other industries which are more kind of business to business or local industrial companies, I think it's a much earlier stage of that, and it can sometimes be a bit reactive. So occasionally you'll have a scandal of one form, and then companies will then rush to kind of not use that supplier. But maybe you would think if they had done some more homework at the beginning, they would have got there. So I think it's slightly different across different industries. Where we have emerging market companies in multinational supply chains, they're kind of already there. I think consumer companies, food retail in particular, we see a lot, and then beyond that, I think it's a work in progress, and probably, as I say, starting more on the environmental side with things like scope 2 and 3 and moving to social over time.
Just sort of finding them, sort of looking at sort of some case studies. John, you sort of talked about Safaricom earlier in terms of it might be a sort of an example of a relationship between a company and its surrounding sort of communities. You got any sort of other sort of stock examples or case studies which sort of bring the whole sort of theory to life?
Yeah, sure. So I mean, we talked about Safaricom earlier. We also talked about Shenzhou International, the textile company, which has won a lot of business through having high standards. I guess another feature of emerging markets tends to be that we have some very big employers of labour in emerging markets, and so you have a number of companies where to operate at the scale they operate, they just have to have a very good relationship with their workforce, or else it would be very hard for them to grow. So two come to mind there, different industries. One is an IT services company in India called Tata Consultancy Services, provides IT services to global multinationals. They employ 550,000 people. And then I'm also thinking of Yum China, which operates the KFC and Pizza Hut franchises in China, employs 450,000 people. So kind of fun fact I always think about is that there are more people working in Pizza Hut and KFC in China than in the Chinese Navy. It's kind of that big. These are both companies which it basically, when you're at that scale, if you want to grow 10% a year, you're having to hire 40,000 people. If you had half your workforce leaving every year, you'd be hiring 240,000 people, and that's just not doable. So the only way you can grow and succeed as a business at that scale is to keep your employee turnover down and to have employees who are pretty happy. I think two different companies, different industries. There's some similarities and some differences. So what are Tata Consultancy doing? In that case, it's really all about radical decentralization and empowerment of their employees. They have this huge company. They split it internally into 100 mini companies, each with their own kind of mini CEO, profit and loss statement, cash flow, balance sheet owned by that individual. So there's a lot of opportunity for people to have management roles even in a large company. They can make decisions quickly. And basically, they have that kind of trust of management, but they also have trust of the ordinary employee, and they have this kind of real sense of I guess individual responsibilities when it comes to to working from home. They were very early in moving everyone to working from home during COVID, and have said on the way back in that people can really make that choice for themselves. When it comes to training, they provide huge amounts of training resources for their employees, but instead of mandating that you have to do this course today, they just kind of try and incentivize people to be self-motivated and do it themselves. And I think that kind of personal responsibility and decentralization is really is when you talk to employees at the company, that's really what comes out, and they appreciate that a lot, and that does help them. In the case of Yum, it's been a lot about the work they do in the local communities, and that really creating a sense of culture that employees buy into. So when COVID started in China, in Wuhan, which I guess we all remember, they basically allowed any employees who wanted to go and volunteer in the relief effort there to just leave their work and go and do that. They provided a lot of food to people working during the pandemic. And it's even smaller things as well. They run a lot of, certainly some classes in their restaurants in times when they're less busy. So they have reading classes for children in times when they're less busy. They've been an early mover on some of the kind of broader sustainability issues which their employees are interested in. So they kind of stopped putting plastic toys in ahead of some of their Western peers, and were giving out children's books and some of the kids' meals and this kind of stuff. So there's a real kind of ethos around the company, and you get this feedback if you kind of conduct employee interviews, that people really buy into that, and again, that's kind of how they're managing it. So I guess those are kind of two companies at scale having to manage their relationship with their employees and just doing it in a way which is, to be honest, setting standards on a global basis, even though they're in emerging markets and some of the issues are local and different. But I think those are another two examples to add to the Safaricom and Shenzhou we spoke about earlier.
Great stuff. So Ryan, any sort of final thoughts, sort of questions before we sort of start to come to a close?
Yeah, maybe just one quick one for John, was just around two really interesting examples, and like you say, market leading globally, really thinking how they're doing it. But just curious around kind of how perhaps a manufacturing business versus a service business, and do you pick up a difference? A lot of ESG funds are kind of focused on asset light businesses. That kind of old fashioned heavy manufacturing cyclical type approach doesn't feature so highly. So from a manufacturing and particularly from a social perspective, do you see those two going hand in hand, or are they actually not happy bedfellows?
They definitely, the social issues are important in both contexts. I think the ones that are most important maybe vary a bit, and if you wanted to really slightly glibly classify it, you'd say probably in the services sector you're worried more about happiness, and in the manufacturing sector you're worried more about health. So it's kind of a health and happiness split, and obviously some of the heavier parts of manufacturing are excluded typically from ESG funds on the E factor. So there are a lot of health and safety issues in open pit mining and this kind of stuff, but you're not going to own businesses in that space in the ESG context. So to some extent, some of the heavy manufacturing gets kind of removed. But within things like electronics manufacturing, textile manufacturing, we touched on earlier, it's all these issues around essentially how workers on the shop floor are treated. And I think everyone will remember going back a decade now, the issues that the Taiwanese electronic manufacturing company Hon Hai had within the Apple supply chain, with employee suicides and that kind of stuff, which obviously that was a bad time for Apple and a bad time for the employees of that company, and they've done a lot to move on. But the kind of questions you want to know about are these questions around are there minimum provisions to keep people well and safe within the workplace, and the basic stuff there is very much around things like exposure to toxins within factories, particularly in the electronic supply chain, where some of what is being soldered onto circuit boards can be quite dangerous, and you need to ensure workers have the right equipment to keep them safe there. But it's also more basic things about whether buses are provided to take people on and off site. If they're staying on site, what kind how many people are sleeping in this the same dormitories, is it 30 to a room, or is it some kind of more manageable number? And it tends to also be issues around are you feeding these people yourself, or are you making them eat food on site out of wages? And if that's the case, then are we confident that you're really paying these people a true minimum wage versus versus deducting some of these other costs and what that looks like? There's issues of child labor, clearly, and ensuring that employees are at the right level, and some of that is at the company level, some at the country level. It's clear that some countries have lower domestic regulation in place, and so there's kind of a lot of different issues. But yeah, I'd say, as I said, I think manufacturing, a lot of it's about health, and obviously you do care about happiness, but health is kind of the most material and most basic thing. With a service company, health is typically less of an issue. It's not dangerous working in a call center in the Philippines for an IT services company in India, but there's obviously the question of how you're managing to keep those employees happy in order to grow the business.
Right, I think that about wraps things up. I just want to thank John for your time today, and Ryan, great questions, really made for a lively discussion. Also, I want to thank everybody for listening in today. Thank you for your time, and goodbye.
Thanks, Adam, and thanks, Ryan. Great questions. I always enjoy talking, so it's been great.